Imagine checking the news and seeing the headline, "The market hits a new high." Your phone buzzes. Nexes are up, indexes are green, experts sound relieved. Then you open your own banking app. Your savings are still there, same number, same digits. And yet, it feels like you're falling behind, not emotionally, mathematically. This is the uncomfortable part that no one explains clearly. Your savings can lose value even when the market is up. Not because you made a mistake, not because you panicked, but because of how the system actually works. And right now, that system is quietly working against savers. This matters today because we're living through a strange moment. Markets rise while people feel poorer. Portfolios recover while everyday costs refuse to come down. On paper, things look fine. In real life, they don't. So let's slow this down. No hype, no fear. Just the mechanics. Start with a simple idea that most people never question. When people say the market is up, they're not talking about your money. They're talking about the prices of assets, stocks, indexes, sometimes real estate. That's it. The market being up means someone is willing to pay more for the same asset than they were before. It does not mean money has been created for everyone. It does not mean purchasing power has improved. It does not mean savers are better off. In fact, rising markets often occur at the exact moment savings start to fall behind. Here's why. Your savings are typically held in cash or cash-like instruments, bank accounts, money market funds, short-term safe places. They're designed to feel stable, predictable, boring, and boring feels safe. But boring has a hidden cost. Cash does not grow on its own. It only maintains value if the world around it stays stable, and the world around it rarely does. Now zoom out. When the economy slows, or something breaks, a recession, a crisis, a panic, policymakers step in. Central banks lower interest rates. Governments spend more. Liquidity floods the system. The goal is simple: prevent collapse. And it usually works. Markets stabilize. Confidence returns. Asset prices recover. That's the part everyone celebrates. But there's a quieter side effect. Lower interest rates change the rules of the game. When rates fall, savings stops being rewarded. At the same time, borrowing becomes cheap. Very cheap. Money starts flowing toward anything that can grow faster than cash, loses value. Stocks, real estate, risk assets. This pushes market prices up, so the headlines say the market is up. And technically, they're right. But here's the irony. The very policies that help markets recover often reduce the real value of savings. Not directly, quietly through inflation. Inflation isn't just prices going up. It's the measuring stick shrinking. If inflation runs at 4% and your savings earned 1%, you didn't tread water. You moved backward. Your balance didn't change. Your purchasing power did. This gap compounds over time. Year 1, it feels small. Year 3, it's annoying. Year 10, it's devastating. This is where the story gets uncomfortable, because while savers lose slowly, asset holders gain visibly. Rising markets benefit people who already own assets, people who can take risks, people who can borrow cheaply. Savings accounts don't get that upside. They just absorb the downside. Now let's add another layer that most people miss. Market indexes going up don't represent the average person's financial reality. They represent weighted baskets of large companies. A handful of firms can carry the entire index, so the market can rise even if wages stagnate. Even if small businesses struggle, even if living costs rise faster than incomes. The market doesn't measure comfort, it measures price. And price can move for reasons that have nothing to do with prosperity. Here's a quiet example. If interest rates fall, future profits become more valuable today. That alone can push stock prices higher, even if the underlying business hasn't improved. Nothing magical happened. The math just changed. That's not growth, that's discounting. Now contrast that with savings. Savings don't benefit from lower rates, they suffer from them. So you end up in a strange situation. Markets rise, savings lag, and people feel confused. They're told they should feel optimistic, but their lived experience says otherwise. This confusion isn't accidental. The financial system is built to prioritize movement over storage, spending more than waiting, investment over preservation. Savings are necessary, but they're not protected by design. In fact, in a debt-heavy system, savers often become the shock absorber. Why? Because debt relies on time. Inflation shortens the real weight of time. When inflation rises, debt becomes easier to repay in weaker dollars. Savings become weaker dollars. Same force, opposite effect. That's why you'll hear officials downplay inflation when it starts. Transitory, temporary, under control. Because inflation is politically easier than the alternatives. Raising taxes hurts immediately. Cutting spending causes backlash. Inflation works quietly. No bill arrives. No vote is required. Prices just drift. Now bring this back to you. You did what you were told. You saved me. You avoided panic, stayed disciplined. And yet, when the market is up, you feel stuck. That's the context. Savings are not designed to beat inflation in a system that depends on inflation to function. They're designed to provide liquidity and psychological safety. Those are valuable, but they're not free. The fee is invisible. It's charged in purchasing power. This is where hype and reality collide. Hype says rising markets mean things are getting better. Reality says rising markets often signal easier money. Hype says cash is safe. Reality says cash is stable only when inflation is low. Hype says patience always pays. Reality says patience without awareness erodes quietly. None of this means saving is pointless. It means saving is incomplete, especially when the system rewards risk-taking and penalizes waiting. Zoom out one last time. When markets rise because productivity improves, innovation expands, and incomes grow, savers benefit indirectly. That's healthy growth. But when markets rise because money is cheap and alternatives look worse, savers fall behind. That's financial gravity. And gravity doesn't care how responsible you were. So the real question isn't why your savings feel smaller when markets are up. The real question is this. In a world where rising markets can coexist with shrinking purchasing power, is watching the market enough to understand your financial future? Or do you need to pay closer attention to what's happening underneath the numbers you're told to celebrate? Perfect. This script is already strong. Below is a clean, professional three-part division designed specifically for separate voice generation and visual generation. I did no rewriting, only precise structural cuts at natural narrative breaks, so each part stands on its own. Pacing escalates correctly, editing is effortless.
If this made you think differently, comment more, and I'll make the next video. Like and share this.